Hi, Karan.
Hey Santosh.
Another episode, and this time, this is a new one. So I'm going to start by
Mm-hmm.
directly putting you on the hot seat. Okay, you are a domain expert.
Mm-hmm.
So unlike news channels, I'm not going to settle for an diplomatic answer.
Mm-hmm.
Hot take. What do you think? What is your broad market view for 2025,
Come
and
on,
why?
it's a trap.
It could be a trap, but I want you to say what it could be and why.
My take is bullish on
Okay.
the market.
Hmm.
Okay. Thing is, last few months have been pretty bad
Right.
in general for the economy. If you look at the GDP growth rate for quarter two, it was around 5.4, which is the lowest in 7 quarters.
Yes.
Okay. If you look at EPS numbers that have come for Nifty, people have basically cut down the estimates for
Yeah.
FY25. Okay.
Hmm.
They started with around 12% growth rate. Now it's down to 5%. It's
Hmm.
basically lowest in 5 years.
Yeah.
Okay. But if you dig deep, you will find some critical reasons for the same.
Hmm.
Okay. See, foundation of our growth story in last 5 years have been basically there have been two legs on which this growth story was running.
Okay.
Okay. So one was government capital expenditure.
Right.
Okay. It has increased from 1.8% of GDP to 3.4% as of now in last 5 years.
Right.
Okay. This was the major growth driver. Second one was private investment into property.
Okay.
Okay.
Hmm.
So one first growth driver that I'm talking about has been missing in action for last 6 months. Okay.
Okay. This
So
is mainly because of the code of conduct
it's
and
basically because of elections.
right.
Okay. There was political uncertainty afterwards. There was also influx of popular schemes from the
Hmm.
state.
Hmm.
Okay. Which basically reduced state contribution in capex.
Right.
Okay. Uh, there was also a issue with extended monsoon.
Right. Right.
Okay.
Hmm.
So basically, the target capex from the government was supposed to be 5.5 lakh crore
Okay.
for first half. It stood at around 4.1 lakh crore. There was a shortfall of around 30%. If you look at compare it with the first half of last year, it's down by around 20%, 15-20%.
Okay.
Okay. When it comes to state capex, it's even bad. Okay.
Okay.
So these populist schemes which have came out of nowhere,
Hmm.
okay, like Ladli Behna scheme and handouts to
Yeah. Yeah. Yeah.
poor women and everything. So that is supposed to bite some 3 lakh crore uh, from state budget, okay, which was not provisioned earlier at
Right.
the start of the
Right.
year,
Hmm.
okay. So even if you look at the government consumption has grown by only 3%, merely 3% in last 6 months.
Okay.
Okay. If you look at the last quarter number, the growth rate was 14%. And this thing, because this was driving the economy over the last 5 years, okay, it had a widespread impact across the board. Cement consumption is negative
Right.
for the
Right.
quarter. Car sales are negative. Okay. If you look at the manufacturing growth rate, it was last quarter it was 7%. Now it's 2%.
Hmm.
So there has been a spillover impact. Okay, and it has also impacted the profitability of the companies, urban demand. You
Right.
know, even the PSUs are behind the target by around 10% of their capex. PSUs are big. PSU trends basically is it's a proxy indicator of the urban spending in
Right.
general.
Right.
Okay, the PSU consumption expenditure and salary bill for a pretty long time. Now, if the thing is that in next 6 months, we expected to see a revival of government spending.
Hmm.
Okay, and we are basically we can see highest ever spending in 6 month in a 6 month period in last 5 years. Okay,
So one of the main reasons why you're bullish is you're saying that in the last year the major factor which has
last
been
6 months.
last 6 months which
Okay,
has been driving the economy that has considerably slowed down
slow, and it will
and
basically
it will pick up.
it will recover. It will recover.
Okay.
It will. There would be mean reversion.
Okay.
Okay,
Okay.
it will recover. Okay. Uh, and the second thing that I'm looking at right now is so if you look at the valuations,
Hmm.
okay, so valuations right now are around 21-22x range,
Right.
21x 22x
Right.
range, P ratio.
Right.
for Nifty 50
Yeah, yeah,
companies. Okay, it's a historical average is around 23.5.
Okay.
Okay, so if you look at the range of 25, if you look at the level of 25,500, in terms of valuations, considering the present EPS scenario, is the optimal level. Okay,
Okay. Okay.
okay,
We are
we can
closer to the average.
we are closer to the average. We can say that that's the peak. That's the above it, market is overvalued. Okay,
Right.
and if you even look at the long term trend line of Nifty, 25,500 at 25,500, you are around 20% above the mean line. Again, it's a big resistance zone, which basically call for a reversal.
Corrections. Yeah.
Okay. So what we are looking at in third quarter, I also expect third quarter to be a bit muted. Okay. In
Okay.
general, in capex, third quarter is muted. If you look at the trend, in fourth quarter we can see massive recovery because everybody would be near the target. They have to meet the targets before the end of financial year. You can see massive approvals. Okay. So I don't see EPS recovery to come in first 3 months. I expect Nifty to remain range bound from 23,500 to 25,500 depending on global signals and EPS trends. I see Nifty hitting a new high only in April, May. Okay.
Okay.
April, May. Once there is a capex recover fully in quarter 4, and I expect the FY26 is expected to deliver a EPS growth rate of around 16%. There is an estimate. I am taking conservative view. It would be 10% only.
Okay.
Okay.
Mm-hmm.
So if you look at the EPS growth of 10% from 25,500 levels and valuation in line with historical averages, we get a level of 28,000. Okay. For Nifty
Okay.
for Nifty 50 at the end of 2025.
So both in
But
terms of
this is a conservative estimate. It's
essentially you're saying both drivers in
Mhm.
terms of the government spending and also in terms of the valuation that we are looking at of the overall market.
Mhm.
Uh, in both the scenarios, you see a upside that is still that can come, which can sustain an upside in 2025, right?
Yeah.
That is the main view that you're
See,
taking.
thing is, I see market on upside. Basically, I expect market to remain range bound from 23,500 to 25,550 to 500. Okay, till March.
Mm.
Okay, in from April, May, we will see a revival in EPS growth. Okay, next year EPS growth is expected to be 15-16%. So ideally by December, they should be level should be around 29,000.
Mm.
Okay, but let's go for a conservative estimate.
Right.
Okay, so it should be around 28,000. We can look at.
Okay.
Yeah.
Okay. Fair enough.
Yeah.
So you've put your neck out there.
Yeah.
So that is fine. So now in terms of uh, the dangers, the watch
Mm.
outs. Okay. What are some of the key risks that could actually derail this growth story in 2025?
So first is US.
Hmm.
So valuations are near dot-com bubble period.
In the
Okay,
US
in the
markets.
US market, you are looking at around trailing 12-month P ratio of around 30x,
Hmm.
which was last seen in 2000 year 2000.
Mm-hmm.
Okay, just before dot-com bubble.
Wow. Okay.
Okay,
Hmm.
basically I will say in run up to the dot-com bubble. Okay, forward P is around 23x for financial year 25 for the year 2025. Again, last seen during the
That
dot-com
sounds
bubble.
ominous.
Okay,
Okay. Hmm.
uh, if you look at there are a lot of contrarian signals. Household wealth, if you look at the distribution of US household wealth, 48% is in equity markets. Okay, in 2010 it was number was 25%. Okay, so guess when it was 48%,
In
again at the time of dot-com bubble. Okay,
yeah.
so there are a lot of contrarian signals which are coming. Okay,
Right.
and the major problem with US is the growth is not very uniform. Okay, if you
Hmm.
look at the EPS growth has been decent in last 1
Right.
year, and people are expecting around 13% EPS growth, which is massive for
Hmm.
S&P 500.
Hmm.
Historical average is around 10.
Hmm. Hmm.
Okay, but the growth is not very uniform. If you look at the last quarter numbers, okay, for top 7 companies, okay, EPS growth rate was around 33%.
Right.
Okay, for rest of 493 companies, it was 4%. Okay,
Okay.
so there is a massive risk that these behemoths, if they fail any growth bottleneck going forward,
Right.
it will have a dynamo impact on entire market. And if you talk about the valuations, people
Right.
are talking a lot about valuations of Magnificent Seven. You say, okay, Mag 7.
Yeah.
People say the if you look at the smaller 490 companies, even for them, forward valuation is at around 19, which is a historical high.
High.
Okay, so the second thing regarding US, basically these valuations are at level where even a small hiccup or small disruption can basically push market into a wider sell-off. Okay, the second thing is policies of Trump administration. Okay, a lot of people are ignoring basic fact that US budget is around 6 trillion.
Okay.
Okay, so they have created a Department of Government Efficiency, which is much trumpeted up, and they are saying that they will cut down budget by around 2 trillion.
Okay.
Okay, that's a 33%
Yeah.
reduction in government expenditure. It is not possible, simply not possible, to do it without having a small recession. I'm expecting that recession to happen in March. Okay, and Fed would actually be forced to cut down rates much faster. Then we have now scheduled that they will cut down to 50 basis points by mid 2026. I'm expecting a much faster rate cut cycle.
Because you will have to, given
You
this.
will have to.
Yeah.
Okay.
Yeah.
So this is one risk which is there, but it will be a pain for 3 months for Indian markets. Okay, but eventually it will recover.
So this is a point that you touched upon that I want to expand upon, which is you've painted a very dramatic scenario of the US market, right? But in terms of its impact on the Indian market, I mean, of course, you cannot not have an impact. It will definitely, there will be. But would it be right to say that the Indian market is a little more resilient, given that the Indian consumption story is better?
See, you have to consider the fact that Indian IT companies form nearly 20% of Nifty 50 index. Okay, FIIs, despite recent sell-off, hold around 16 to 17% of our markets.
So there will be a significant.
There will be an impact, but I see you will see massive rate cuts by RBI, central banks across. There would be a liquidity gush that would be there. Okay, so market would eventually recover on basis of fundamentals. In the long term, it will be positive for US as well. Okay, so as if government cut down on their expenditure, okay, they are planning to basically reduce the headcount by around 80%. These are dramatic claims. I don't know, but Trump has been known to deliver on these. Walk the talk. So 80% of headcount. So it will reduce to lower wages. Okay, basically lose labor market. Okay, and it will help S&P 500 company margins in long term. Margins would be better. Okay, and it will be good opportunity for India as well. So you have to see that. India has the largest proportion. Nearly 34% of Indian corporates have ROE of more than 20%. That's the second largest after US. Okay.
In terms of concentration.
In terms of concentration, talking about the quality of the companies, is the highest concentration of high quality companies.
Right.
If you look at the ROE, return on equity for the market, is the second highest in the world, again after US. So if there are any short term disturbances in US, India would be the chief beneficiary.
Okay, because the money has to flow out somewhere.
Yeah, but there would be some short term pain that would be there.
Okay.
Second is Trump tariffs. Okay, which will result in yuan devaluation.
Ah.
Okay. See, India has a very pretty ambitious manufacturing targets. Okay. They have Make in India program. There are PLI schemes. Okay. They have target of taking manufacturing as a percentage of GDP to around contribution of manufacturing in GDP to around 25%. It's languishing at 15% for pretty long time now. Okay. There are when we say the GDP 10 trillion GDP by 2031, these all are basically foundation of these numbers lies in hopes that there would be some manufacturing exports would reach around 1 trillion by 2028.
Right.
Okay.
Right.
Overall Indian exports would reach around 2 trillion by 2031. Okay. At present they are 776 billion. Okay. Yuan devaluation basically would make Chinese product. If Trump, let's say, again walk the talk on some random tariffs, 30%, 40%, 50%, rapid yuan devaluation would basically make Chinese products cheaper
Yes.
in foreign markets.
Correct.
And it will undercut Indian exports.
Yeah.
India do not have luxury of a planned devaluation. China has it. China has hard reserves, which are built on trade surplus and current account surplus. India forever has been running current account deficits. Okay, and the most of the money is in terms of FII inflows. Okay, so if your currency is depreciated, returns for those foreign investors goes down. Okay.
Okay. Correct.
So India
Correct.
cannot compete in that planned, depreciation thing. China is basically going on path of Japan at a very, very fast clip. Japan took some 30-40 years to reach there. 30 years to reach there. China is basically going there in 5-6 years.
Yeah.
Altogether. Japan did the same 10 years ago.
Yeah.
Okay. So this is one thing that can put your manufacturing targets in danger. Yuan devaluation would definitely put some question marks on that.
Okay, so then I'm going to circle back to this question saying everything that you're saying sounds very ominous, sounds very negative in that sense. Yet you started off by saying that 2025 is very positive for India. So, like, how do you reconcile this?
See, there are a lot of things which are going on for India. See, central government has very good if you look at the finance book of central government, it's in really good shape. Okay, they have hit the fiscal deficit targets. Okay, their infrastructure spending has been increasing over the last 5 years. They have been green shoot in private capex. Okay, so if you look at the historical data, private capex used to be 6% of our GDP in 2007 when our markets made a new peak. Again in 2011, those boom years that we say. Okay, people popularly called it animal spirits. Okay, of the economy. You awaken the animal spirits of the. Today it is at 2.9%. Okay, so
private capex. Okay,
and they have in green shoots. Is this first time in last year it started to reverse downward trend. It went to 2.7. It started to reverse. Okay, you can see boom in real estate. Okay, real estate prices, project starts, and everything. RBI is going to reduce the interest rates by around 50 basis points in first quarter. That will again incentivize private sector to invest more. Okay. So these are the problem with in last 5 years is it's a government driven growth.
Right.
Okay. And that comes to my third danger, that third point that I'm coming to. So there's a lot of political risk that comes with government driven model.
Correct.
Okay, state driven model. So like we saw, there were elections, there were basically restrictions on project approval for 6 months. Practically economy was running without its major growth driver.
Right.
Okay, governments can change. Okay, there can be instability.
Yeah.
Ultimately, priority of government is to stay in the government.
Obviously.
Okay. So they might delay construction of a bridge or construction of a road 3 years down the line and distribute the money to the constituents to stay in the power.
Correct.
Okay. So private sector, the private sector money is much more committed because there the main priority is making money.
Correct.
Okay.
Correct.
So that money is much more stable.
So would it be
And
right to say this? So would it be right to say that so far, even though the government-driven initiatives have kind of driven the growth,
Mhm.
the reason why you're bullish about 2025 is because there are still a lot of private, drivers which
See,
have not yet
thing
kicked
is
in.
that I believe that there would be twin drivers. Government can still support infrastructure growth,
Mm,
capex growth. Okay, at least central government can do it.
right.
Okay, their finances are in pink of their health.
Mm,
They can definitely do that. Okay, and there is second driver with RBI rate cuts on horizon. You can see a revival of private capex. It might reach in next 2 3 years to 4 to 5% of GDP.
right.
A lot of people talk about bubble,
Mm,
and there would be bear market and there would
mm,
be carnage in the market. I am saying that it will come once private capex reach around 5 to 6% of GDP. This present model that we are seeing right now
mm.
is pretty safe. There's
Okay.
no risk.
Okay. While
Okay.
there might be some short-term pain because of like foreign factors,
See, governments can change,
right?
governments can
And
fall,
also because of the
their
foreign
priorities
factors.
can change. That risk is there. But if a government can continue to increase infrastructure spending by 10% or 15% every year indefinitely, which we also know they would not be able to do.
Right.
Okay, at some point of time they have to stop. Okay, this is a pretty safe model, a state driven model. Okay,
Okay.
so risk would enter market. Okay, we will see a sharp valuation expansion once private capex reach some 6% of GDP. Those levels, you will see a valuations of around 28x, 29x in Nifty 50,
Where
and
correction,
return of a core inflation. Right now, people are talking about inflation. That is food inflation, seasonal inflation. If you look
right?
at the ex food inflation, it's around 4% only. The core inflation will go to 8 to 9%. That time, real risk of a market, market carnage or a bear market would enter into play. Don't see it in next 2 3 years. I might be Diwali 2027 might be the time it start playing out.
Okay. So thanks for that.